Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, April 15th, 2019. Tax day, FYI. I imagine most of you in the U.S. already have your returns, at least your extensions off by today. Just a heads up on that. I want to do this video. I did just a brief update this morning. But I want to get this out. I'm going to just, even though it's broad market coverage, I'm going to keep this one members only and say this, that, the market, despite the resiliency, one thing that hasn't happened yet is we haven't taken out or burned through a lot of the bearish developments. And typically, not always, but typically, the longer the market or a stock ignores whether it's bullish developments that are forming or bearish developments, usually the reversal when it comes is quite powerful. And what I'm trying to say is, whereas for the last couple months I was looking for a correction in the market, I'm looking for more of a waterfall type sell-off at this point in time. There's nothing guaranteed. I'm not trying to be dramatic, but from my experience with what's gone on, with what's happening in the economy, I'm factoring in micro fundamentals or macro fundamentals, factoring the technicals. And again, I see just dangerous, potentially dangerous developments in the market. So, despite that the trend is up, that's happened many times in history. It's happened both to the downside and the upside. And usually, when you have, these type of market conditions, yeah, it leads to pretty powerful moves. So again, maybe something coming up like we saw back in the fourth quarter of 2018. Maybe not, but either way, let me get this video out to you guys, and I will, most likely add back some official short trades. As I've told you, we've had, never in history, we had some runs last quarter before the top, where we had a couple, just an unusual amount of stops hit. This time around, as you guys know, we've had at least three short attempts on QQQ this year so far. We came into the year long and bullish. About halfway through the move up, I was looking for a correction. We had a couple, and they were smaller than what I expected, and so therefore tried to position for a larger correction. Now at this point, again, the magnitude of the next correction I think will be a lot larger. Let me just put it that way. But here, let me get this video out to you guys, try to get this published. I did a brief update this morning on the front page, highlighting the developments in the futures. Really, that's what I'm watching here. And this is NQ, the NASDAQ 100 E-mini futures. You'll see something similar on QQQ. But we had so far an impulsive breakdown. I talk about that quite a bit. Remember, I've had to modify this trend line last week because we limped down through it very unimpulsively. This is impulsive selling. That's one candle on the 60-minute chart here. And you can see that red candle is the largest red candle we've had. These were impulsive candles back here. These were impulsive candles, as were these. And those usually come during, early on and then during a correction. So that looks good right there. Now, of course, we do have a lot of support. That's what happens when a market has been slowly walking higher. You have a lot of support levels below, so I'll just highlight a few here. You can see the lines on the chart. This one I don't have a level. Look, really the same lines I've been highlighting for weeks now. Nothing there has changed. So we're going to look at the daily charts real quick and some individual stocks, but there it is. So there's the divergences that have only extended. It's not as if they haven't played out. They've just built and grown larger up until this point right here on the 12th. And that's when we topped, came down a little bit, and then a breakdown today. Now we do need to see ES break down. This is what I call a minor trend line. It's not super well defined, but there's enough reactions there. So we do need to see that go. There's even slight divergence steepening there at the highs. We had a little push up there. So you can see the divergences continue to extend. And let me give you one other level to watch on ES. Right about here, right about actually where we hit. And what I'm doing there, it's you can see the reactions right here and here and here. 1, 2, 3, 4 reaction highs. So here's what you need to see. It's about 28.99, maybe 2900 or so on ES. You need to see that level go, and then this trend line. If that happens, especially with what's going on in QQQ right now, that would be one of the better sell signals we've seen in a while. And again, if you look at the divergences, they've just continued to build for quite a while now. Okay, so as I mentioned this in the trading room earlier today, that breakdown of those 60-minute future charts might give us a jump start or a heads up on a more powerful sell signal. We still need to see, because of the resiliency of this trend, and I will say this, fool me once, shame on you, fool me twice, shame on me. It's just the nature of this market, lots of breakdowns, sell signals on the 60-minute charts. In fact, every one of our the short trades that we had on QQQ this year were based on the 60-minute charts. So what we really need to see to help put the nail in the coffin, or increase the chances you're going to get a decent correction, is a sell signal on the daily charts right now, the daily time frame. And that's what we're looking for. So you can see, go back, look at these candles. We had a big red candle there, but it wasn't a bearish engulfing candle because it didn't engulf the previous candle. And so that's it. When I look at the daily chart here, and we've had minor trend lines, you can see there's one there. No, those broke, and they certainly led. Again, there were corrections here. They were just relatively shallow corrections. So what I'm looking for at this point in time is still this uptrend line off the lows on the 24th of December. Quite a few reactions. I'm going to stretch it out here. You want to give it the benefit of the doubt. Come in, try to capture that candle there, about where I had it. So I want to say this, we're just right on the line right now. So we don't yet have a sell signal, and I may pull the trigger at any point in time, and if it happens really quick, I may just throw out the fact, say QQQ is a short trade, and then I'll follow up with the price targets and the other trade parameters. But again, trade as you want. I want to get these videos out in advance just in case things move fast, because it can take a while to mock up a chart, add this, all the trade parameters, the targets, the stops, and then compose that post, take the screenshots, and get it out there to you guys. So again, I think it's just we're building energy here is what I see, with the markets continuing to wedge higher. A lot of the, again, not all, but a lot of the economic indicators rolling over. It seems to be employment is really the two things keeping this market going, besides the Fed, pumping it full of liquidity and keeping rates low and being dovish, of course, and the stock buybacks. It's the one thing that hasn't buckled yet is the consumer. And the consumer won't buckle with unemployment at record low levels. So you're going to watch employment closely. Again, sometimes it's a chicken or egg thing. And what I think may happen here is if we get a breakdown and we get a pretty impulsive sell-off and a decent correction, that will immediately impact consumer confidence. And consumer confidence goes into consumer spending, which of course is, as I said, about roughly 2/3 of GDP. So there's a lot of moving parts, is what I'm trying to say. And we can try to fundamentals. You can't trade off fundamentals. The data comes in, and you get bombarded with it every week. There's all different types of economic reports, and there's a lot of aberrations. In other words, 1 month the report might be down or up, and that's why a lot of the economic reports, they'll use smoothing, they'll use averages and things like that. So technicals are going to be our best guide, is what I'm trying to tell you, is to figuring out where the market's headed from here. And right now, that's the level I'm looking at QQQ. I've been watching this, and you can see we're on it again. Pretty impulsive move down, but support is support until unless broken. And although we had that, I started the video out with the 60-minute chart of the NASDAQ futures, the daily chart takes precedence over the 60-minute charts. So all we did here is we had an impulsive move down, we hit support. You want to see this trend line taken out with conviction, either a very big intraday move, impulsive, or a close below that level. And you can see if the trend line's taken out, our first support comes in. It's minor support, but about 182.83. And by the way, I did get a price alert, but I've tightened this trend line up. Sometimes you'll get alerts on a daily chart, if I had the trend line, because it just tapped that trend line, and I moved it out a little since I started the video. But you can see I'm coming in pretty tight on this candle here, tight on that one, tight on these two, and now this is a yet another reaction there. So again, you want to see that level taken out. Let's just look at a few of the top holdings and then we'll wrap this up. Let's look at Apple. Apple is again like the Qs, right on the trend line. Remember, there were a couple of quite a few of these FAAMG stocks had a one-day little whipsaw signal. We had one candlestick below there, and we snapped back up the following day. But there's still a lot of reactions to help validate that trend line is an important level, and we're on it again. So, what will probably happen, my guess is, when it breaks, and it could break today, it could break next week or next month. But what will probably happen is you won't limp down through it. Once it breaks and you see maybe at least 3 of these big market leading stocks go down, by the end of the day you'll have a big red candle. That would be my guess. So you may want to pay close attention, because if it happens that way and all of a sudden all the stops on the longs are hit and the shorts start to pile in, and especially day 2 you have another move down, you could have wiped out weeks, and probably will at that point, weeks of gains, and also deny you a very objective entry. Because if you do, I'm just using Apple here as an example, because if you wait till right here and then you say, wow, okay, those are pretty powerful sell signals, I see a lot of other stocks broken down, well, you've missed an objective entry. Because you're in no man's land. With Apple, for example, I have the first minor support right here. This is the first decent support. And I'll just tell you right now, that would be my target for the next pullback in Apple. I don't care whether it starts up here, or today. I think it'll come back to that 175.50-ish level. But again, this isn't the most opportune shorting level here. Just again, hypothetically, we're still up here in price, because at that point you get a sharp sell-off. You're going to have the dip buyers. They always come in, especially early on in corrections. Most corrections, I should say. Again, I think we have some excessive conditions right now in the market, and sometimes those lead to the big, quick waterfall type sell-off. So just have your ducks in a row, be ready to go. And remember, if it doesn't, if we do get the dip buyers to step in here, and let's say again halfway down, maybe you kick back and you come in and back test. And so if you short there, you may get stopped out just on a simple back test. So again, I'd rather jump the gun on these and keep losses small, like we have in the last few trades. Where the stops have been about 3% above entry price. You can take a string of those, 2, 3, 4, 3% losses, 12% total if you have 4 of those losses. And then again, I'm just looking here. This is Apple, not the market itself, but there could easily be 20% or more downside once the turn finally comes. Let's look at a few more of these and we'll wrap this up. Microsoft, there it is, just a beautiful clean wedge. Again, I have these divergence lines. They're flexible. As long as we continue to go up, the divergences will be extended unless they're taken out, meaning we take out the previous highs. But again, these are all the levels I'm watching. Want to see all of these get taken out, and with big red candles, the more you see, the better. I'm just going through the holdings of QQQ in order of market cap. Amazon gave up the ghost today. This is the one I had a price alert earlier this morning on Amazon when it broke this trend line. That is but again, that's only one of the market leading FAANG stocks, but that's a pretty impulsive breakdown. See, it didn't just limp through there. That's a big red candle, one of the biggest candles we've had at least in weeks, you can see, and well below trend right now. Divergence on the RSI, and I'd have to hone in. I can tell you, let me move that line down. That would be the first target. But I will also say this. I'll have to check to see when Amazon reports. That's first and foremost, because earnings can change everything, and you don't want to take an individual stock short right before earnings. That's another thing. That's why QQQ is probably the best way to go for most at this point in time as we head into earnings season, because you don't have to worry any one company gapping, blowing it away, going up or down or for or against your position isn't going to have as big an impact on QQQ. So just keep that in mind. But Amazon, that would be the first target on a pullback. But what I was getting at here is, Amazon's probably not going to drop another, where are we at now? If I can grab roughly where we're at, it's probably not going to fall another 4% if QQQ holds this support and rallies. especially before they report. So that's certainly a consideration to make. And why? Because Amazon, again, is one of the largest components of QQQ. So not just due to the inflows and outflows of the ETF that are affecting it, it's also investor sentiment. The rest of the Qs and the FAANG stocks are rallying. People are going to buy Amazon. They're going to step in and buy the dip. So you want to see this break, and then Amazon will probably continue lower. All right, a couple more, and we'll wrap it up here. GOOGL, I already shared this the other day. I have these early trend lines and the benefit of the doubt trend line. Here it's a little clearer on the other share class. There it is. The yellow trend line is our early trend line. The white is the BOD, or benefit of the doubt trend line. Not one of my favorites of the FAANGs right now, long or short, but just wanted to cover that. Facebook short interest is very low right now. There's a couple trend lines and a very nice support level here. Roughly, it's not a hard line, but about 174. So seems to be a pretty important level, all the way down to about 171 or so. But let's just put that line right about here. Call it 172-ish. So there's really a whole confluence of support right here on Facebook that it needs to take out, and that's all the way down here. If it takes out 172, it will have taken out the trend line. So if you want to focus on one number, let's just round it down a little and call it 172 for Facebook. Big divergences forming. We had divergences back here that led to a drop of 44%. We had a divergent high back here, which led to a drop of, oh, there it is, 23%. So that's what I'm looking at. Some nice swing trades coming up here once we get these sell signals. Intel, early trend line right here. You can draw that one off the lows about late January. And potential trend line, again, I already covered this in a recent video. I'm not going to go into too much detail. First target down there around 50.68. Cisco, this one looks nice. Nice uptrend line right here, well defined, pretty steep wedge type pattern. Negative divergence. The only thing missing right now is a sell signal, which would be an impulsive break below that level. And again, the more of these that trigger around the same time, the higher the probability that breakdown will stick. You get just one, like Amazon today, pop through, or even two, but they are early warning signs if you start to see these leaders break down. Let me be very clear about that. Just because you have one or two break down and the rest of the sector doesn't go down doesn't mean everything's hunky-dory. On the contrary, you're starting to see some big leading names break some pretty well-defined support levels. Comcast, same story. I mean, this is the story on the Qs. This is why I'm doing this video. These are the top holdings. I'm just going in order of market cap, and they all look very similar. They're all walking up dangerously steep and extended uptrend lines. By extended, I'm referring to overbought conditions, and sooner or later, those overbought conditions will usually manifest in the form of a correction. Same with the divergences that you have building as well. Disney, I don't see much. I mean, there's potential, certainly extended, and so it's not a stock that I'd be chasing right now. It was a clear breakout there, but again, what'll happen is if and when the Qs correct, Disney will feel the selling pressure no matter how rosy things are. Obviously, they had some rosy earnings or something here, guidance and all that. But again, that's only going to take the stock so far. And if Qs come under heavy selling pressure, you'll probably see this one come back down. Wouldn't be surprised at some point this year to see this big old gap backfilled too. And from where we're at right now, that would be about 9%. Now, again, not one of my favorites. I'd just leave that one alone. All right, let's just wrap it up here. I can go down the line. As I go down the line, each of these stocks has a smaller and smaller impact on the index. So I covered the big ones already. And again, I'd probably be remiss not to mention XLK. There it is. We need tech to break. Tech breaks, market breaks. 1, 2, 3, 4. Not yet 5 reactions. You want to see a reaction or a break. At this point, this is a pretty ripe wedge, meaning mature, ready to break, very extended uptrend line. So this one can break down any day now. And again, what I'd like to see, the more impulsive the move down, the better it is for sell signal. So if you could get something like this one day, big old red candle like that just wipes out engulfs the last couple weeks of trading, that's very bearish. And why? One reason is all these right here, a lot of this were FOMO trades. FOMO, fear of missing out. That's been the big buzzword lately in the market. We know this statistically. We can look. We know the majority of retail investors were out. How do we know that? We've seen, I believe it was a record number of outflows from U.S. stock index funds or U.S. equity funds in the first quarter of 2019. So what does that tell you? That tells you the retail public not only wasn't buying the rally, they were pulling their money out because they just had a shot across the bow here, and they said, I'm going to take profits, I'm going to get out. There's something broken in this market. So that is a big red flag to me, number one. Yeah, you can spin it both ways because I know the bullish side to that says, okay, well, investors tend to have bad timing. They pulled their money out. Now all that cash is in money market funds and bonds. It can come back into equities. I'll give you that, but I'll just say at this point in time, until and unless it comes back in, that's a red flag. So we know they've missed out. And undoubtedly, some of them were buying recently, chasing the market again for a FOMO trade. And what happens is they get wiped out. They're weak-handed if they've just gone in recently, and especially if they did it not for fundamental reasons or long-term investing, but again, just fear of missing out. When you wipe those people out, or move down below where they bought, they're quick to sell. They're not going to let this happen again. They're going to stop out. And so what happens is, correction usually starts a little slow, and then you get that waterfall type sell-off as you start to go down. We saw it last in the end of 2018, and we may see it again. Hasn't happened yet. I'm laying out the scenarios and just kind of be ready for it if it does come that way. And of course, the flip side to that is maybe the fear of missing out trade is just getting going, and maybe that money again repopulates back into the market, and we get a blow off top if it comes. As I said, I can't foresee it, and I can't make an objective case to go long. The risk reward, the technicals, the fundamentals, everything doesn't warrant it. So this market can pop 10. It can pop 20%, and it can do so without me, and that's fine. I won't be short 10 or 20% on the way up. I'm not going to add any official short trades until we have those sell signals confirmed, and I will just focus on other pockets that aren't overextended, overbought, like I have been recently with some of the auto parts stocks and some of the other things that we focus on, the shipping stocks, things like that, where I'm more comfortable trading because they're trading near 52-week or multi-year lows with strong bullish chart patterns. Again, that's the key. These are bearish chart patterns. So the market wants to do this. It's fine to do it. It can do it without me. I'm not going to fight it, but I'm looking for the next move this way right now. Okay, and that's it. Let's not try to really read too much more into this. Again, the market's hardly down today. Tech is down a quarter point, so I don't want to make a big to-do about this. Right now, QQQ is down 0.39, but again, better to get these videos out, my thoughts out in advance in case we get that scenario, so you guys can decide whether to exit longs, engage shorts if that's what you're looking to do, and just in case I can't get the an official trade out on QQQ or the semis or anything else. And probably told you I wouldn't digress, but that's certainly one I'm watching as well. Bearish engulfing candle today doesn't mean much unless we get some confirmation follow through to the downside, and that would also be, by the way, if we get it soon. Boom, this right here. Oh, let me box that in for you. This is a breakout to new highs in the semis, and if we move much lower, that would be a failed breakout. As of now, a breakout is a breakout. It's bullish until and unless that breakout fails. It's these divergences that tell me not to chase that. Otherwise, I like breakouts to new highs. If this is, semis had consolidated, maybe they come back in here, hit that trend line, consolidate a little, take out, burn through the divergences, and then go on to breakout later in the year. And if the broad markets look good, that may be a breakout that I might be on board. Not this one. I'm more apt to wait and look for some signs of a reversal or a failure for a swing trade on the short side. But as of now, not in the semis, just holding off and watching. And remember, again, we're heading into earnings season. Double check every stock you take. And the benefit of ETFs are you have safety in numbers diversification. So one semiconductor blows it away and you're short the semis, you're not going to get killed if you're in SOXX as you might on an individual stock that you hold into earnings. We will wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.